So for obvious reasons, we've changed our usual Meet the Manager interviews to a virtual format. But we're still delighted to be joined online by Shane Hurst, who's a managing director and a portfolio manager of the global infrastructure strategies at ClearBridge. Shane, thanks very much for joining us. Could you give us a brief introduction to yourself and who ClearBridge Investments are?
Sure, and thanks everyone for listening in. ClearBridge Investments is a global equities manager, over $100 billion in funds under management. Myself, I'm a senior portfolio manager at ClearBridge Investments. Have been part of the team here for over 10 years. I sit across all strategies at ClearBridge Investments infrastructure teams. And certainly oversee all the portfolio construction here.
So we initiated coverage of the Legg ClearBridge Infrastructure Income Fund, which ClearBridge are the investment managers on, and we did that earlier this year. And we were particularly attracted to this strategy for a number of reasons, really. So the portfolio offers diversified exposure to listed equity securities of businesses offering services and facilities which are really critical to the functioning of the economy, really. So that could contain gas, electric, water, transport or communications, etc., etc. And this portfolio has a number of quite unique characteristics. So one of which, important for a lot of clients, would be a high dividend yield, which has been pretty resilient this year against what has been a pretty challenging broader market, particularly for income investors. And those investments are also backed by long duration assets, often predictable cash flows, and often built with some form of inflation protection. But I wondered if, to start off this call, we talk about some of the kind of other structural trends which we think are kind of really driving growth in this sector. And so, Shane, I wondered if we could touch on the utilities, the electric utilities. I know that the kind of US and European electric utilities make up quite a large part of this portfolio at the moment. And we've noticed many of these companies either increasing or transitioning their portfolios to renewables. Could you talk us through kind of how that is changing this sector, and how the utilities stand to benefit from the energy transition away from fossil fuels?
Absolutely, and that's a great question. So, if you look at our strategy, about 60% is invested in global utilities, about 18% in US utilities, and to your point, about 24% currently in European and UK utilities. Now, no doubt, decarbonisation over the next 3, 4, 5, 6 decades is going to benefit the utilities, whether they be electric, whether they be gas, or whether they be water utilities. And just to give you an example, if you look at the IEA, the International Energy Agency, and you look at their view really on achieving a 1 to 2% warming scenario, so 1.5 to 2% warming scenario by 2050, that would entail $1.7 trillion of investment per annum for the next 30 years. To your point on renewables, current renewable capacity globally sits at $2.5 trillion, 2.5 terawatts. And by 2050, that's expected to ramp up to around about 12 to 13 terawatts. So that's, again, a huge investment. In this case, we're talking an investment of around about 10 trillion euro. And so when you step back and think about it, a lot of this investment will be done by utilities. And a lot of the targets out there are highly supported by governments around the world, whether you're talking about the European Union, who has 2050 decarb net zero limits, targets of net zero by 2050, whether you're talking about the US, where 7 states have a net zero target by 2050, 7 more have a 50% renewables generation target, or whether you're talking about Australia or China, they all have these very aggressive targets, which will lead to increased investment for utilities into renewables, into hardening of grids, into improving these grids to take on the challenges of decarbonisation over the next 30, 40, 50 years. And so, when you look at regulated utilities, you look at renewables that we invest in, the contracted renewables, what you see is many years of very clear growth set out for them, and that's really through that asset base, and that asset base for a regulated utility, as an example, earns a regulated return off it. And frankly, these are some of the kind of the safest, most reliable cash flows, which ultimately translates through that dividend and dividend growth.
Sure. So I mean, as you've laid out really clearly with the numbers of this energy transition, this is probably one of the biggest structural changes in the economy over the next several decades. It's also a trend which has been well talked about and has had a lot of investor demand. Are you seeing that in heightened valuations in your investable universe?
Yeah, no, that's a great question. And look, I think you need to bear a few things in mind. Firstly, the answer is to a certain extent, but the group itself is very attractive. That's kind of the bottom line. If you look at the type of cash flows that our assets have, very stable, very consistent cash flows, we don't believe markets globally have priced the multi-decade growth. If you look at global utilities, they currently trade on a 10.9 times EV to EBITDA. We think that's still very attractive as a group, and within that group, there are obviously opportunities in the way we invest. If you look at global renewables in our universe, 11.5 times EV to EBITDA, and again, for a sector which is going through multi-decade growth, again, we don't believe that's being fully captured.
Maybe if we move on from the utilities. So utilities have been really very resilient in what's been a challenging year so far, but the mandate also allows you to go into other infrastructure areas, and others have more obviously had some challenges. I mean, the transportation sector, just one obvious example. Could you talk us through how the funds navigated through this year so far?
Yeah, no, totally. Look, if you go back to the end of last year, we were defensively positioned. Our view was we were coming to the end of a long cycle, and so as a result of that, we had high exposure to utilities. We had lowish exposure to infrastructure. And so as we moved into the COVID period and that huge volatility, what we saw was really a bifurcation of markets. Different markets around the world behave differently, as you'd be very, very aware. In places like the US, your defensives were your large tech stocks. And so utilities there actually underperformed. In countries like Australia or in countries like Canada, it was really a utility type bifurcation. So utilities did very, very well there. In general, though, if you look through that period and that volatile period, utilities, contracted renewables, communication stocks performed very, very well, had very little impact. And to your point, transport infrastructure and really airports had the greatest of impact. When you think about what we did through that period, and just to put it in context, we did what we call an investment triage. As soon as we entered that volatile period, that included looking at liquidity of companies, looking at the balance sheet of companies, running scenario analysis. We called up the companies we invested in, understood where their hotspots were. Specific to this strategy, we spent a lot of time looking at the yield quality, so the coverage of the dividend, the forward growth of that dividend, and the size of the yield, and how sustainable that actually was. And so as we moved through the period, in terms of changes to the portfolio, we reduced our exposure into midstream North American midstream, really on the view that hydrocarbon and the value of hydrocarbon infrastructure assets, so gas and oil, would fall over time as you see this decarbonisation trend evolve, and they weren't really reflecting that into their current valuations. We reduced some utilities where clearly their investment thesis and catalysts had played out, and we entered into some very attractive renewables and also some US utilities and some European utilities. And so if you think about if you think about how the portfolio looks now, and really to the point of the dividend yield, which is obviously absolutely crucial to you and crucial to the management of what we did back in the COVID period, we impaired our dividend by 40 basis points. So it went from 5.5% forward to 5.1%, very conservatively. And the reasoning behind that was we wanted to make sure we could deliver that number absolutely. So we wanted to be really conservative. What we found, and sorry, that impairment really came from the airports in the portfolio, which are very small, about 4%. But obviously, because of their transparency of cash flows, they most of the airports we invested in impaired their dividends. As a result of that, what we found really over the last 3 to 4 months is that impairment was far too conservative. And the reality is it really only had to be about 20 basis points. So we are getting a greater dividend than we expected from those assets. So, as we sit here today, in terms of the moves we've made, how the portfolio looks, the portfolio has around about 60% in regulated utilities. We've taken the opportunity to increase transport infrastructure where we think we can find very good value, whether it's close to scorched earth valuations and the transparency of forward cash flows and forward dividends going forward, most important, forward dividends. We still have a very high renewables weight, or a reasonable renewables weight at about 15-16% of the strategy. And we have about 7 to 8% exposure to North American pipelines. So that's kind of a snapshot of how we've gone through that period.
Sure. Yeah, and I think it's worth even putting that income resilience in the context of the broader market, because I mean, from the perspective of the UK market, I think we're seeing estimates at the moment for around just 55% of the income that was generated in 2019, looking like it'll come through in 2020. So really significant lack of income from the equity market, particularly in the UK. And Shane, I wanted just to finish off, if we could maybe look at some of the other. We talked a lot about decarbonisation, energy transition, the impact on infrastructure. If we could talk about some of the other kind of structural trends that are out there that are really driving potential growth in your universe. I'm thinking things like communications. So, I mean, another big trend is a move to 5G connectivity. Is that something that can be played through this portfolio?
Yeah, no, that's a great question. And look, we spend a lot of time talking about decarbonisation, and people think that's the only drive of the portfolio, which is absolutely wrong. Let me just go through quickly kind of 4 kind of key or interesting themes that are playing out through our portfolio currently. I think the first is more of a structural one to infrastructure, which is just the continued need to maintain infrastructure globally and to invest in infrastructure globally. There has been a chronic underinvestment in infrastructure, even though currently $2.5 trillion is invested per annum into infrastructure. Really what's needed to hit GDP growth numbers out to 2035 is more like $3.7 trillion. So there's a $1.2 trillion deficit. So that underpins the capital growth for really all the infrastructure systems, whether they be utilities or transport infrastructure that we invest in. So that's one broader thematic. Another interesting one, which has somewhat gone under the radar, it really is in US utilities, and this is part of the reason we've increased our conviction in them over the last few years, but certainly through the volatile period where they screen very attractive. They are going through this big change. If you go back 20 to 30 years ago, Most US utilities were what they call integrated. So they had not only regulated components, but they had exposure to merchant power. They had exposure sometimes to oil and gas pipelines, other services. They sometimes owned telecommunications providers. And what that really spelled was inconsistency of forward cash flows. And that meant that the sector itself didn't have the rating it should have. And what we've seen over the last 3 to 4 years is the really kind of cleaning up of that sector. And as a result of that, cash flows out of the sector are more consistent. And you know, to the extent that there'll probably only be 1 or 2 integrated utilities by the end of next year. So we think that's going to positively contribute to the quality of cash flows, quality of dividends, and ultimately the rating of the sector. Another key theme, as we've talked about a little bit, is just that recovery coming out of the COVID pandemic. You know, that's a big feature of infrastructure. You know, there are some airports, some roads down 20-30% in terms of share price from pre to post COVID. Now, if we go back to 2019 levels of traffic in airports by 2024, valuations will be back where they were. I mean, there's no doubt in my mind. So, you know, that you know, affects part of our portfolio, and is a very, very much a positive driver, that mobility driver, as vaccines get disseminated, etc. So, and then finally, to your point, you know, 5G. You know, we certainly can play that through our tower investments. We own Crown Castle in the portfolio, and you know, 5G is an interesting one. I mean, you get 100 times the speed of 4G, which is, you know, pretty good, to be honest. And you know, how do the tower companies benefit? Well, they benefit 2 ways. They have increased spectrum, so you know, increased way to distribute that frequency, and for that they basically lease out extra tower space. They also have existing telcos who are using those towers who need to upgrade their equipment. And just in terms of size of that investment, we're talking over $260 billion US to get that 5G up, and that really underpins the core growth, the core 5 to 7% cash flow growth of our tower companies out to 2028. So look, there are a number of themes. You know, you obviously throw in decarbonisation as a fifth, but you know, there's no shortage of thematics and you know, really good drivers of value within our strategy.
Shane, thanks very much for that. That's been a really interesting intro into the strategy. If you'd like any further information on the Legg Mason ClearBridge Global Infrastructure Income Fund, you can contact your investment manager for a copy of our recent research note. And again, thanks very much, Shane.